Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew, back again.
Trying to change that intro just slightly so it doesn't sound recorded and it's not the same one. It's recorded live every single time, Andrew. So, mate, how you going?
I'm good. I'm back from holiday, so what's not to be good about that, Bills?
Well, the fact that you're not on holidays.
Actually, that's true.
So, but looking at you, you look very tropical, you look tan. So obviously you got to a nice warm spot with lots of sun. So I'm jealous and let that be a takeout from everyone is go and book your holiday. I reckon that's the key.
Done. I'm booking the Bills.
Awesome.
Next week.
Yep, let's do it.
Another week annual leave.
Just bring the podcast mic with you, the laptop, internet connection, and you'll be fine.
Exactly right. Exactly. How you going, Bills? Everything going well?
I'm good. I'm pretty excited about today's topic, actually, I must say. You know, we've been talking in, I guess, the last couple of weeks around superannuation. We're going to continue that theme today. And traditionally, it's been a fairly mundane topic, but today we're going to take a slightly different approach and talk about something that everybody loves or should love. Definitely I love it, is the war on tax or the amount of tax that we pay in Australia. We're going to talk about a really, really beneficial strategy with inside superannuation and how do we use this strategy to essentially pay less tax. And in this instance, it's designed to avoid, let's go and call it a death tax because death taxes don't really exist, but in this context, they do. And with a little bit of planning, if we manage to get this right, we can prevent needing to pay for that using superannuation as a vehicle. It'll make a little bit more sense once we jump into it. But the big takeout is with this, we're going to talk about paying no tax if we manage to get this right with inside superannuation. So I'm pretty excited about this. It continues on the same theme of superannuation.
I think it does, but it doesn't. I mean, it's a superannuation theme, but at the same time, all that you're doing is basically using the super fund as a vehicle to avoid tax. Like it's not about putting extra money towards super. I mean, it can be, but it's not about, driving more funds towards it because obviously, environment that's tax-free while you're earning it is, we've spoken about it at length in the past, but, a great strategy in that regard. But this is using your super funds to basically just move money around, create magic and save on tax. I love it. And I think it's such an underutilized strategy. I mean, the amount of people that, we've spoken to about and clients that we've spoken to, this kind of strategy about, and it's just completely unbeknown to, 99% of the population. Yep. And it's a tax that's completely avoidable. You can, do a couple of pretty simple, pretty easy, steps and all.
No, hang on. Let me stop you there. They're not simple. They're extremely complicated. It's part of our financial wizardry and our financial magic that we do from our end.
Well, once we run through the numbers,
you're right. It is generally speaking, it's quite simple, but
the concept of it is quite simple. You got to be careful around how you do it when you use it and how you utilize it so that you can use it to its maximum effect. And we'll run through, some numbers, but as a bare minimum, if you're enacting on this strategy, and not as a minimum because you want to make sure that you haven't breached your non-concessional limits, but we'll run through these numbers. Doing this strategy once will save your beneficiaries based off a really simple scenario, 56 grand per person, $56,000 in tax.
It's a really good teaser. I think what I might do is I might just frame specifically in real simple terms. We are getting excited specifically in terms of what we're talking about. So in Australia, we do not have an inheritance tax as it currently stands or a death tax. Although in the case of superannuation, in the event that the member passes away, if the proceeds of superannuation go to, I'd say, the wrong person, so a non-tax dependent beneficiary, there is tax that's payable on the superannuation proceeds that the beneficiary receives. So with some of the work that we do and what we're proposing in terms of our recontribution strategy is we're changing what that looks like. So when that person does receive that money, they receive the full amount, they don't pay any tax on it. And in the illustration that we've got, there is a fairly large dollar saving that goes into the beneficiary's pocket rather than going to the taxman. So we're talking essentially about not paying tax on a superannuation benefit that you receive as a beneficiary, receiving that money in its entirety and not losing any to the taxman. Essentially, in our world, it's called a recontribution strategy. Andrew, let's get into some specifics and let's figure out how we do this.
All right. So we'll dissect sort of two elements to what Billy was talking about. Now, element number one is to determine whether there's any tax that's payable on a superannuation benefit that gets paid out. Now, this is in the event of death. So touch wood, someone passes away, superannuation gets paid out to their beneficiary. In the first step in determining whether there's any tax that's payable on that is determining whether the superannuation is taxable or whether it's tax-free. So there's two elements to your superannuation fund that get recorded. If an employer or if you're making pre-tax contributions towards super, it's going to go in as taxable. So most people's superannuation balance, unless you've made after-tax contributions, are going to have a taxable element to your superannuation. And for most people, that's the majority of your superannuation.
So concessional contributions where you've paid the 15% tax gets recognised internally. I don't think you see it on your statement. Gets recognised as a taxable component within inside your super.
Exactly right. Exactly right. So for most people, I mean, if you think about the standard person that's making some salary sacrifice contributions, that's working as an employee, most people's superannuation balance will have, or the majority of their balance is going to be taxable. The only time that you're going to have a tax-free component to your superannuation is if you make an after-tax contribution to super. So you've got money sitting in your bank account, you've already paid tax on it, that money's sitting there and you decide to contribute that towards superannuation. That goes in as tax-free. So if you've got money that's tax-free in your superannuation, irrespective of who it gets paid out to, there's no tax that's payable on it in the event of that passing on to a beneficiary. However, if money is in the taxable component of your superannuation, which is where the majority of people's superannuation is sitting, if that gets paid to a non-SIS tax dependent, mouthful of words, but I'll sort of get to what that means. If that's paid to a non-tax dependent, then that is going to attract an element of tax. And the minimum and what most people will usually pay, without going into a huge amount of detail, is 17% tax on that. So what a non-SIS dependent or a non-tax dependent is, or what they are for most people, is an adult child. So a child that's over the age of 18 and not dependent is not classified a tax dependent. And so if any proceeds go to, and it's usually an adult child, that child, when they receive the superannuation, so if you've got a superannuation balance of, let's just say $1 million, and that is all taxable, and that's all going to get paid out to a non-tax dependent child. Yep. Sorry, mouthful of words. Got it. That child is not going to receive $1 million. What they're actually going to receive is approximately $837,000. So $170,000 is going to get paid to the taxman as a really, you're talking about it's a free kick to the tax.
Free kick to the taxman.
So we're talking about fairly significant numbers. And even if you're talking about smaller numbers of 500,000, you're still talking about $80,000. Even if you're talking about, even larger numbers than that, then you're talking about even more tax. So what we're talking about here is effectively trying to drive down the component that's in your superannuation that's taxable and convert that to tax-free.
So that's the financial wizardry, getting the taxable component and swapping that around to get it to tax-free. I mean, conceptually, that sounds simple, moving it from sort of one categorization to the next. How do we go about it? Because doing that obviously makes sense, especially when you start talking larger and larger numbers. Any amount of money that goes to your beneficiary rather than the taxation department is great. And it sounds fairly simple swapping it around.
How do we just swapping it back?
Well, it's not as simple as swapping it, and that's what we're going to get into now. I mean, look, how do we go about doing it?
I think even taking it one step back, the question that I'd ask you, Bills, which is the question that I get asked all the time, when you start, talking to a client about something like this and you start informing them that, hey, there is going to be an element of tax, because even if you're a husband and wife, and even if, you're each dependent or both of you are beneficiaries to each other, yes, the proceeds are going to go to your partner in the event that you pass away. But once your partner passes away, where's it going to go? So eventually it's going to go most of the time to a non-tax dependent. So the question that I always get asked is, if I'm going to pay tax and the money's in superannuation, why even have it in super? I can pull the money out. Let's pull it out. Why don't we pull it out, Bills?
You can pull the money out and not have to worry about at the end of the day when say your adult children or your non-tax beneficiaries receive it, they don't pay any tax. Yep, sure, you can pull it out. That's simple, that's easy. But going back to some of our earlier episodes about the power of having money in pension phase, in drawdown phase, inside super, you're not paying any tax on income and you're not paying any tax on earning. So you're foregoing that tax-free environment, which is extremely substantial, and gold versus trying to solve for a future problem. So in my mind, it's kind of the toss-up between, hey, have we got enough money to live now in this environment versus, hey, I want to try and protect and give as much to my beneficiaries as I can at some particular point in the future. And who knows when they're going to fall off. We don't know when we're going to fall off our perch. But the strategy that we've got, the recontribution strategy, in terms of the mechanics behind it and how we do it, we can actually have the best of both worlds with some planning, and in combination with our previous podcast around some of the changes that are happening 1st of July, this has made this even more accessible to more and more people. So we might get into the tactical element and how we go about it. But in terms of, why you just wouldn't take the money out of super, it's too big of an opportunity to forego to worry about, your lifestyle today versus your beneficiaries tomorrow. If you're in a tax-free environment inside super needing to generate an income for your lifestyle, you'd stay in that environment hands down because you need to live. And why wouldn't you do it and not pay tax versus take that money outside of super and you'd have to pay tax along the way as you start to generate wealth and income out of the back of that investment?
Yep. So if money's inside your superannuation, you're saving tax for yourself. And if money's outside of superannuation, then you're saving money for your beneficiaries, or you're saving tax that your beneficiaries are going to have. So really what we're doing here is utilizing the best of both worlds, and we're trying to save tax on your own personal income and also save tax on your beneficiaries and, how much they're going to pay when they eventually, inherit the superannuation balance.
I'm just hearing save tax. That's all I'm hearing. That's all I'm hearing. And I've got this big smile on my face and I'm like, yes, absolutely. Andrew, how do we go about it? What do we do as practitioners? What do we do as financial planners? How do we help our clients achieve the best of both worlds? So protecting what they've got now by not paying any tax, and also protecting their future beneficiaries and avoiding this inheritance or death tax that's within the superannuation system that not really many people know about.
Yep. So look, as I said earlier, it's quite a simple strategy. Other than moving money around, you're not doing really very much. The complexity around this is making sure that you're not breaching the withdrawal limits and you're not breaching the contribution limits, which obviously we'll touch on the limitations of this strategy. But effectively, when this strategy becomes powerful is you think about really two main scenarios. Someone's over the age of 60 and they're no longer working, and when someone's over the age of 65, irrespective of their work status. And
in that instance, your superannuation becomes completely accessible, which is the reason why we've got those two as kind of the key timeframes in this strategy.
Exactly right. So superannuation's accessible. You're not paying any tax on withdrawals. So again, let's use the scenario. You've got 300 grand that's sitting in superannuation. It's taxable. And so what you want to do is convert that 300 grand from taxable to tax-free so that your beneficiaries don't pay tax. What do? You withdraw the money from superannuation. So either over the age of 60 and retired, or over the age of 65, irrespective of your work status. You withdraw all of the funds from superannuation, put it into your bank account. You don't pay any tax on that. Either the next day or very shortly afterwards, you contribute those funds towards superannuation. So those funds go towards superannuation as an after-tax or non-concessional contribution towards super. Now, the funds, obviously, when you're withdrawing them, need to be in pension phase. So, as we've touched on in previous podcasts, there's accumulation and there's pension phase. And then when you recontribute the funds to superannuation, they need to go back into, obviously, the accumulation fund because the pension fund isn't able to receive contributions. But the essence of what you're doing is basically withdrawing money from superannuation and then just recontributing that exact money back into superannuation as a non-concessional contribution. And because you've contributed it as non-concessional and after tax, it's tax-free.
Simple. Simple. So summarizing that all in...
Sound like a meerkat bills.
Simples. So summarizing that really succinctly is you're taking it out of super when you can.
Yep.
And you're putting it back into super.
That's it.
That's it.
That's it.
Right?
And let's look at a number, right? So
And it's never as simplistic as that. There's a little bit more that goes behind it. So we need to be conscious about how much we can put back into super. But it's as simple as taking it out, which converts it from taxable to tax-free, and then putting it back in tax-free, which when it's received by the superannuation fund, it's recognised as a tax-free component, and it then no longer attracts any inheritance or death tax when it's paid to any beneficiary, regardless of who they are or what the tax element of the category looks like. Adult children, you name it. It makes no difference.
Yep, you're
That's simple.
Exactly right. It's as simple as that. So you look at a scenario, right? Let's just use and this is a simple scenario because you can actually drive this home significantly more than that. But you look at really the largest limit, which is a non-concession or the non-concessional contribution limit. The bring forward rule allows you to do $110,000 in 3 batches and bring forward 3 years worth of after-tax contributions towards superannuation. So total limit on superannuation after-tax contributions, $330,000. You pull $330,000 from your super fund from the pension phase, you recontribute it back into your superannuation fund. That $330,000, if it was just sitting in the pension phase or accumulation phase and it was taxable, would have attracted $56,000 on a 17% tax rate. So your beneficiaries would have paid $56,000 on that if they received it as a lump sum in the event of your death and they were a non-tax dependent. By enacting the recontribution strategy, that $56,000 is not paid in tax. So you have all, in an instant, by simply withdrawing funds and recontributing it, you've saved your beneficiaries $56,000 in one transaction.
Hang on. Let me emphasize this because this is pretty exciting, right? So in its simplest form, this strategy with the contributions that can go back in. So we're talking about not the restriction about getting money out. It's getting money back in that poses a little bit of complexity here. With the smallest amount of money that you can, or, because you can do this strategy multiple times in the right financial years, depending on what you've done in previous years. But at the bare minimum, you're talking about $330,000 that would be received by a beneficiary, converting the tax element. 17% of that is $56,000. So if your beneficiary was going to receive $330,000 as an inheritance, they're going to pay $56,000 in tax. You're telling me by just doing this, you've just gone and eliminated $56,000 going to the tax man and the whole $330,000 going to the beneficiary.
Exactly right. And you think about it, if there's a couple and all of a sudden you're doing this twice in one financial year for each parent, let's say, that's $112,000 that you're saving your beneficiaries in tax in one transaction.
All I'm hearing is that our younger listeners should be telling their parents about this
exactly
and telling them to go and get advice, because those numbers there, is extremely significant. And, it's part and parcel of what we do as financial advisors day in, day out. But this is phenomenal. It's
the benefit of it is unreal. There was some limitations on this previously, and I think it's timely that we're talking about this because previously you were limited by how much you could put as a non-concessional contribution. Now, obviously, if you're over the age of 60 and retired, then you can sort of start enacting on this strategy. But for most people, or for a lot of people and a lot of clients, they were working all the way up until age 65. Now, 65, you've got unrestricted access to your superannuation. Previous legislation was you couldn't use the bring forward rule after the age of 67. So you were limited to only being able to do $110,000, every financial year. So you consider that client, and the strategy is still really beneficial, but ultimately you've got between the ages of 65 and 67 to do it. So you're going to do one $110,000 tranche at 65. Then you can do another $330,000 tranche at 67. And that's it. And I'm not saying that's it by underplaying. Like the numbers that we've ran through are ridiculous.
But the window becomes a lot smaller.
Exactly.
Whereas,
1 July, the new rules are coming in that you can use the bring forward rule all the way up until 74. So you can effectively do this strategy. I mean, you're talking about bringing forward 3 years from the age of 65 to 74, probably 3 tranches. So $990,000 per person per superannuation balance, or, per person in a couple, let's say, that you can effectively shield from tax. The opportunity is huge.
Yeah, this is crazy. I mean, look, even just those smaller numbers that we were talking about on the minimum side, $56,000, but you can avoid, keep running your numbers up, but it's avoiding 17% tax. And if you're talking hundreds of thousands of dollars, then that's huge. Absolutely huge. Just on that note, sort of throw back to our episode last week, we covered a fair bit in terms of the superannuation changes that were coming in or are coming in 1 July 2022. That sort of leans into what you're talking about the contribution rules being extended to age 74. So that covered off a lot of that, but that's created a hell of a lot more flexibility for this particular strategy. And in our world, any client that we're talking to that's hitting certain ages, so we're talking 60 and not working, or 65, this is almost the first thing that we're talking about to them when we're having the conversation around their superannuation or retirement planning, because it's not just thinking about them and have they got enough to retire on and what does that look like, but you're also actually talking about the next generation as well too. And that becomes extremely powerful because, you're taking all of their circumstances into consideration, and it means more money in the right people's pocket. And not that we don't want to support or do our fair share around the tax perspective, but the government does not need another free kick when it comes to this stuff. So if we can use our financial wizardry and our financial prowess, absolutely, why not?
Yeah. And at the end of the day, there is still some benefit to be had. And I don't, want to downplay it, but there is still some benefit to be had even if you're still working and over the age of 60. So you consider someone that, is still working and over the age of 60, the biggest limitation to this strategy is how much they can draw from their superannuation fund. The amount that they can draw from their superannuation fund is 10% of the balance. So depending on what your balance is, you still can enact this strategy earlier and start to take some small benefits in the early years and then some larger benefits in subsequent years. So you consider someone that's, 62 years old, still working, has a superannuation balance of $500,000. Well, the max you can withdraw from superannuation at that stage is 10% per annum, 10% of the superannuation balance. So you can recontribute $50,000 each financial year until you turn 65 years old, and then commence either the bring forward rule and use $330,000 or $110,000 in non-concessional. So the earlier that you get onto a strategy like this, the better off that you're going to be, because of the fact that the bring forward rule is exactly as it sounds. You're bringing contributions forward. You're not looking back. So if you don't utilize it this year, let's say, then you're not able to utilize the unused portion in the next financial year. Yep. So the earlier that you start engaging with a financial advisor or looking as to, whether this strategy is a viable option, the better off that you're going to be. And every financial year that passes that you're not utilizing this strategy, you're basically losing.
You've missed that opportunity. Yep. No, well said. There's probably 3 things that I think consideration needs to be given to with this particular strategy. I mean, we're talking about some really big benefit here, and that's fantastic. But like always, there's a bit of a trade-off, and 3 of the things that we need to consider. I guess the first thing is, there are some transaction costs associated with it. Ordinarily, you wouldn't necessarily do this strategy just because of the complexity of it. Hopefully we've made it sound easy, but there is some complex and there is some technicality to it. But you probably would not do this without the help of a financial advisor. So that's probably the first thing. Depending on the assets that you're buying and selling, there's probably some buy-sell costs and some transaction costs associated with it. In saying that, the benefit that you'd be receiving or your beneficiaries would be receiving would far outweigh any costs associated with it. However, it is a consideration.
Yeah. And I guess I mean, should be reflective in what we've talking about, but again, important to highlight, it's a selfless strategy. Like, you're helping your beneficiaries by receiving more funds in enacting this strategy. And sort of important thing to note is it's not actually doing anything to your own personal tax that you're paying every year. It's the amount of tax that's going to be paid by your beneficiaries when it's paid. So that transaction cost and that buy-sell cost is going to be borne by you, but ultimately that's going to yield and I don't want to pull out numbers because buy-sell costs vary from assets and funds, but
for the benefit, it's insignificant. Yeah. You can safely say it's insignificant. There's no issues, but yeah, it's like anything. It's something that you need to take into consideration. Probably the second thing I think is quite important is around the withdrawal rules in particular, and they're fairly straightforward if you're looking at it. The one that has complexity, which people will get caught out, is not when, but how much money can you contribute back? They're probably the two things that you need to take into consideration. When can you withdraw it and when can you contribute money back in? Once again, especially because there is some changes coming in at the start of the financial year, yeah, you're going to need a financial advisor to help you go through that process. But that's another consideration in terms of enacting this strategy. And Andrew, probably the last thing from a beneficiary perspective, that's probably the last thing that I'd say we need to pay attention to.
Yeah, I mean, and it's in this strategy, but really in general, making sure that the beneficiary nominations that are nominated on your account are reflective of your actual wishes and reflective of the overall strategy. So, you might have a will, but if your beneficiary is to go to the estate that is going to, dictate the will, that's going to attract a different tax than if your beneficiary is to go directly to your partner and bypass the will. So making sure both in this strategy and in any financial planning strategy that your beneficiary nominations on your superannuation accounts are reflective of the overall strategy and who you want the money to go to, because there are going to be some tax implications depending on who your beneficiaries are.
Yeah, because you could do all of the work here for a recontribution strategy, and if you don't have your beneficiary nominations set up correctly to support that recontribution strategy,
it's all for nothing.
It's all for nothing, and your beneficiaries can end up paying tax.
Exactly.
Once again, depending on who those beneficiaries are. But yeah, you could get caught out from that perspective. Absolutely. Yeah.
Yeah. I think that kind of covers it, Bills. I mean, that was, I'm especially now with some of the changes that are coming on 1st of July in terms of how much you can contribute to super and whatnot. It's massive. Previously, there was definitely a massive benefit in a strategy like this, but it kind of hit, a niche of clients that were in that sweet spot in terms of age and being able to, enact something like this. But this has now just opened the gates and opened, the ability to reduce the amount of tax that your beneficiaries are paying. And I think that's massive.
Not paying tax is always exciting, Andrew. Absolutely. Absolutely. Let's not downplay it. But look, like always, well said, well summarised. I think that there was a fair bit in that, and I'm looking forward to listening to this episode back because there's just so much gold associated with it, and it's such a valuable strategy. It means more money in the right hands. It means less tax or no tax. It's kind of like the perfect outcome.
Yeah, and you're talking about big numbers. Like, we're not talking about, dollars and cents here. And a few $1,000s that you might save in tax, yeah, a lot of people will go for it, but a lot of people are also like, I don't know if it's worth the hassle. But we're talking about a significant tax saving and a pretty massive amount. I mean, you think about if you wanted to pass on, $100,000 to, your beneficiaries, how much work, how much effort, how many correct investment decisions it takes to make that amount of money versus a strategy that, on its surface is fairly simple, but fairly quick and, quick to transact upon. The impact that it can have is really huge.
Well said, well summarised, Andrew. Hopefully the listeners got a whole heap out of that. And if they didn't, and if that doesn't get you excited, I don't know what is. But look, as always, thanks to our listeners for your time and attention. I hope you got a lot out of it. Andrew, to you, thank you so much for the episode. I reckon it was an absolute great, one of the best ones that we've done. Yeah.
Always a pleasure, Bills. Thank you. And thanks again to our listeners. Again, if there's any questions, anything that you want to run through in detail, you want us to look at your own personal situation, our details are in the show notes. So feel free to reach out to myself or Billy, and more than happy to have a chat.
Catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.